Okay, welcome everybody to MoreTalk, where we are hosted every Thursday live. We're the only radio format, so you're probably listening on Spotify or YouTube podcasts, which come out every Sunday. This is Adopt the Brand. Some of our sponsors are Velix Valuations, which is an appraisal firm. I love introducing it to people because they are traditionally used to the AMC model. Also, Silverworks Solutions, one of my favorite introductions as well on really automating everything. So I would love any lender to reach out to me on those two. I am excited to speak today, and today I have Eddy Perez, a guest on our show. Last week we had on MoreTalk, which again, 2 p.m. Eastern, 11 a.m. Pacific on LinkedIn Audio every week. We had Greg Schur and Jay Promisco, who both run IMBs, who really said raw things for the first time ever. And not for the first time. I mean, they've been saying it on LinkedIn, but Jay jumped in, and I reached out to Eddy because Eddy and I had a great dinner at the IMB conference, and it really allowed me to see a different side of Eddy. When I grew up in the industry, Eddy was one of the first and nicest people, and I told him to reach out to me and help protect me from, I don't know if that's the right word, but help make sure I at least felt comfortable, in that scenario. And then for a while, you've really been leading, Eddy. And so we hadn't talked for a while. And then talking with you, I just realized how the story on LinkedIn that you tell versus the raw Eddy is so different. And that was the raw Eddy I always knew. So I thought it'd be important to tell everybody. So thank you for coming on the show here today.
My pleasure.
For context, just real quick, I guess you could talk about EPM, and then your experience, which goes all the way back in the gamut of the Mortgage Bankers Association. As listeners know, I am a big fan of advocacy and a big fan of pointing out people that don't advocate but have a lot of opinions. But you certainly advocate and have, including the hardest position in our industry, which is MorePac chairman.
Yeah, I mean, some people consider it hard. I will never tell you that it was easy, because great things in life are not easy, but it was simple in the sense that you had to grow more people to advocate. It's always better to have 10 than to have 5. And it was a lot of fun. It was the greatest leadership journey of my life, because I learned so much in the 4 years that I was involved, because first I was vice chair for 2 years, and then for 2 years I was MorePac chairman. And I'm very fortunate to say that I got to serve in some of the most crucial moments, which was during COVID. And, everybody remembers the margin calls and all the problems. And I got to be involved during that time frame and be in a lot of meetings, given that we're really moving the needle for the whole industry and the whole country for that matter. So I considered it a privilege and an honor to have served at that time.
And I think when people see your LinkedIn, they see a lot of the videos you do about empowering others and having the right mindset. They don't see, I don't think, enough of the podcast you have. And you had Bob Brokesmith on the last one. You've had Gary Vaynerchuk on it. It's on season 6 now. We'll certainly put that in the comments section. But you had Bob on it, yes.
Yeah.
Most recently, what was some of them? I mean, you talk to him all the time. Did you learn anything through that podcast, or as I was listening, anything?
It's funny. The podcast for me is a little bit different than for most people. For most people, and there's nothing wrong with this. There's another medium to brand yourself, to really put yourself out there. I view it as an opportunity to really lift others up, because I like to hear people's stories. So, connecting with people and engaging, you learn a lot about them and certain journeys. And I think that's really important to the listeners, whoever your listeners are, wherever they are, since that can be done globally, because that's where people really, really learn. Are you going to learn more from a book that you read that gives you pointers, or, reading the autobiography of Steve Jobs and his journey? More than likely Steve Jobs. You learn more from stories than you do from techniques, because most of those skills, a lot of us already have them, or they're already there, or they're close. And it's really understanding how to apply it. And I think through stories, that's more important. So the podcast, to me, I usually don't learn a whole lot outside of other people's stories. But more importantly, it's about getting people to see others, because I don't have a huge following online, but between Instagram, LinkedIn, Facebook, it's roughly about 80,000 or so. And I think that you never know who it's going to touch and make a difference. And that's really what I'm trying to do, is pay it forward.
Yeah, and I noticed you do have that Shannon Sharp quality where you let the guest speak. I think you speak less during your whole show than I do in one question. So I will give you do a great job of empowering others. You've always kind of been seen, as I walk around, the NBA, and sometimes people say, oh, Eddy, is a renegade. And I think, you touch on it, though. You're not really one. You're just being you, and it's a changing of the guards, I kind of think is how
Yeah,
you
yeah.
word it.
Funny you say that. I still remember my first NBA conference in 2010. It was in Atlanta. It's when I started traveling and growing, and I had just become a mortgage banker 2 years before. And I had joined the NBA pretty much out of Jump Street. And I didn't wear a tie. And you got to think about it. In 2010, I was 34, and I didn't wear a tie. Now, I'll challenge anybody, because I don't believe a tie makes you more professional, because I did have a suit on. I just didn't have a tie. I did have a pocket square, and I had a suit that was,
Lost him there for a second. While we recover, my first event ever, I was told to wear a tie by we hired a consultant who actually was like the seventh person, Bob Gaudet at Freddie Mac. I don't even know if people know him. And he said, whatever you do, you have to wear a tie. I set up 3 meetings for you, Kim Starney at Lender Live and a couple others. And just make sure you wear a tie. And then I went to the last IMB conference. I'm trying to get you up here, Eddy. And I was one of the only two, not the last one, the one before in Nashville. And me and Steve Milner were the only two with ties. And everybody was making fun of me for not reading the right dress code. So, Eddy, I think we lost you at where you were. You were just telling us how you...
Yeah, I didn't wear a tie, and some people looked at me like I was crazy. But, just because you're wearing a red tie in a suit and you got wrinkles in it doesn't mean that you're more professional than somebody who's wearing a suit without a tie. And if you want to call me a renegade for that, I've just always been me. I think it's actually cleaner and more professional not to wear a tie.
Well, and then it came around, and now everybody, doesn't. They wear the suit jacket without it. And so that really gets us into, I think everything is moving so much faster that the old guard doesn't always connect to that. And they... Yep. And that's a perfect example, like where things are moving faster, and can you adjust? And you brought up an interesting point to me, as somebody like last week we heard with Greg on the show, in leadership of top companies talking. Go ahead. You were talking about, so I'll let you kind of say the thought. But we lost a middle age group of leadership, right?
Yeah. So, to your point, we're in a full-blown change of the guard. I mean, how many retirements have we seen in the last 2 years since this started, which is normal because that's what happened in 07 to 09. Pretty much everybody 58 and above. The challenge is, in 08, there were plenty of people in that generation of that mid-30s to, you could say early 50s that were ready to take the helm. My generation, Gen X, got completely eliminated, and it was the smallest generation. So basically, the industry now still has boomers, or Gen Y and Gen Z, and Gen X that's kind of in that right age, born in 1965 to 1980, that is in leadership, pretty much doesn't exist. I mean, there are not a whole lot of people in the industry that are in that demographic right now, that are in leadership positions, that have put themselves in that. So the industry does have somewhat of a void. So it's either going to have to stay older in certain areas or go younger, and kind of like when NFL teams hire a defensive or offensive coordinator, hoping that people can step into that next role. They haven't had the season time to really learn how to be an executive and how to be a leader. Even though they know how to do it, it takes making a lot of mistakes to really, really get great at it.
I've noticed that, and the industry has a tough time skipping generations and bringing up somebody they don't deserve as ready yet. And sometimes they use age as a indicator there, when it sounds like they might have to reassess the model now.
Well, yeah, they're going to be left with no choice. Like I said, there's not that many people that were born in that 70s time frame. Late 80s. Not late 80s, late 60s, early 70s. There's just not that many. They all got wiped out from the financial crash. Everybody at that point was, anywhere from upper 30s to lower 30s to upper 20s, and they went on and left the industry in droves and went. Like I said, very many of my friends that were in completely left. I was one of the very few left over.
And so that old guard, it brings up a bigger problem. The old guard really isn't going to be around long enough that disruption will be full scale, right? And then the
Sure.
ones that should be really concerned would be in the middle because they're going to get the brunt of not just something disruptive, but something disruptive that has the financial vehicle to penetrate the market. And they're not the ones making they're not really driving. There's not really many of them to drive. And the young ones are either not ready, I guess, aren't being empowered, or are almost too tech savvy, right? And then they haven't gone through the education of maybe what makes the mortgage industry so great and why a tech company can't just run it. Where can all these like age groups work together? Is the MBA the place, or is it going to have to be somewhere else, like LinkedIn?
I mean, obviously, LinkedIn, all socials bring people together because that's just advent, the next level of the internet, no different than what our phones are. I mean, as I shared with you, sitting in my car right now, while my son is getting, because he's in concussion protocol for something that happened to him, while I can do all this stuff and keep working. So it's just, you learn how to be flexible and adjust with life. And
But I'll push back. I think what Greg says is on LinkedIn, these leaders, rather than saying how, as an industry, how can we put a moat around innovators, they say, my company's never laid off anybody. Come to us and we will have a showing of our new tech stack.
So here's what I'll tell you about that. Whoever says they haven't ever laid anybody off is strategically giving you an omission, because every organization, regardless how big they are today, are a lot smaller than they were 2 years ago. So either people did layoffs, or they got rid of departments or channels, or through a PIP system, they raised their standard and that allowed them to get rid of it. Whoever says that when the industry was at 465,000 people, August of 21, and today it sits under 300,000, they try to say they didn't cut anybody. I'm going to tell you that that is a strategic manipulation.
What do you say to the broker channel? And I know this is close to you, so I'll be careful. What did you learn from interviewing Andy Harris? I thought that was a very good, because Andy's so great at that channel and about compliance, and he's actually put predictions out there. What did you find most fascinating about what he said?
Did you hear his logos theory, I guess, if you want to call it? We'll just call it a theory just for fun. Did you hear him ever describe logos, like company logos?
Is that where he called the net branch an acquisition without getting any money? Just giving up your
That's
database?
no. Basically, what he said is, you've got people that are buying into an organization, and you have to understand those organizations are just logos. And he's dead right, because at the end of the day, doesn't matter how you get there, unless everybody somewhere or another is going to Fannie, Freddie, or Ginnie, unless they're doing non-QM and then they're securitizing it in that market. But that's still a securitization and a money supply. So the question is, you can't really be loyal to those companies, and you got to be loyal to the consumer and look out for the consumer, because at the end, it's whoever has the best avenue to take you there. I thought that was the most fascinating part, because he's completely accurate on that. He's absolutely dead accurate on that one. And that's why when some people hang their hat on the wholesale channel, or any channel, I would even say that to the retail originator, you have to understand that your company really is a logo. And I'm not saying it's not a great logo, and I'm not saying it's not a logo to attach yourself to. However, at the end of the day, the money supply is Fannie, Freddie, and Ginnie. They're the ones that turn them into MBSs, and they're the ones that go out to the broader market, because no bank and no organization in the whole world has $2 trillion in cash outside of the market, where there's a lot of cash globally that can fund all the mortgages that get done every year. Period. It's just that simple.
Yeah, and in addition to my show, there is Real Fridays, which we actually have one of the co-hosts, Rick Rock, in the audience here. But Jeremy Potter mentioned it on their show last week, saying, let's not act like Freddie and Fannie at the end of the day is an avenue, and if that could get disrupted a little bit there, what's to keep a real estate agent from bringing it directly to them? And I think that goes back to what I say, which is, and it's because I'm there. I'm not saying it I'm there. I'm going to advocacy again for my 9th out of my last 10 years. And people have to understand, I've stayed at my mother's friend's house to be able to afford it at times. This is not something where my company pays me to go. I think advocacy is the moat around around disruption. But when you have the ICE conference the same week and a lot of the big names are going out there, it makes me wonder, and I'm going to be interested. I'm going to go around with a microphone at this conference and do some interviews, but you've been there. I mean, you've been MorePac chairman. How important is the advocacy conference, and what are people missing about it that helps consumers, realize the importance of the mortgage industry as a whole versus just the logos?
So there is a reason why the MBA, and I was part of the Future Leaders program, and it's a phenomenal program. Over thousands apply every year, and they only allow in 30 some. There's a reason that they started at that conference. And the reason is people forget, why sometimes people miss on predictions out there is because of geopolitical influences globally. And even though this is a real estate finance industry housed here in America, because America is the largest economy, even if it's just focused here, it has global implications. You get to learn who are the big buyers of Ginnie Mae mortgage-backed securities. Sometimes it's Japan, Saudi Arabia. Like, people don't realize who's buying these assets. And geopolitical influence, absolutely. Everybody's waiting for a Fed rate cut. A lot of it's not going to be just the inflation numbers, even though that's part of it. A lot of it is geopolitical influence, and that's what you get to learn, because you can know how a mortgage works. You can know compliance. You can know secondary. You can know sales. You can know underwriting. You can know ops. You can even know current events. However, to put it all together and then to also understand geopolitical influence, that's what's going to make you look like you're really predicting stuff when you're really not. The answers are right there in front of you. You just got to know where to look, study, and always stay diligent, because, to your point, things move extremely fast. I mean, 3 years ago, nobody was thinking that the business today, you would see so much that's gaining on the wholesale channel, which, I mean, I understand it makes sense. It's just going back to 2002 when I got in the business, how retail lenders are having a lot of problems reaching profitability. But I'm not surprised with the net branch model, aka, sometimes they call it the P&L model, but it's the net branch model, where there's all these layers and expenses and the margins aren't there. QE isn't coming back, so everybody thinking 106, 108 pricing's coming to bury some of their problems in margin and sell a little bit of higher rate. That's not happening. Those days are gone. The last guard of this industry, that was 15 years. That's all they know. You really think that the same thing's about to show up and happen? You're crazy, man. You're just going to give yourself mental health problems.
Yeah, and we are a radio show, so if you're listening in the Spotify and the Google podcast world, you can come on Thursdays, 2 p.m. Use the hashtag MoreTalk. We have a caller who I had just mentioned, Dr. Rick Rock. Thank you for calling in. That's what I call it, but coming up here. What would you like to ask Eddy, or what would you like to say, a quick thought on what you've heard so far?
Yeah, no, look, I love it so far. I love the format, and big fan of yours, Eddy.
Thank you.
I've kind of watched you from afar. We've actually never met, I don't think. But a big fan of yours, in,
Thank
in,
you.
in your
Thank you.
organization.
That's very kind.
So no, I'm in agreement with you. It's kind of interesting. I've been talking to lenders, just as many of you guys have, where the margins in these net branch models or these P&L models just simply struggle to get to where they need to be, right? So it ends up becoming a tug of war between the corporate margin and the branch margin. And the discussion revolves around just comp and expenses, right? Because there's only so many knobs on your dashboard to be able to
Yep.
adjust to make the numbers work. And I literally was going through a model where there was this one company, they did like 2 billion in 2021, and then they did about $1 billion in 2022, and then 2023 they shrunk to about 420 million. They just are hemorrhaging expenses and costs, and they still had people making 150, 175 basis points.
Yep.
In these P&L models, they had, one person P&L branches, this sort of thing. And I said, guys, you guys are nuts. You have to adjust. You got to make these adjustments. And that world is not, like, I agree with you, Eddy, that world's not coming back. You have to have a tremendous amount of servicing. Like at cross country, we have a tremendous amount of servicing where we can be very patient, and and there's a tremendous amount of management around around making sure that branches are profitable, right? And if they're not, we have to close them, right? But unless you have alternative revenue streams to be able to sort of balance out or relieve the pressure from, corporate margin and fee income, it's just, you're not going to get there, And this one guy's like, all I need, and someone, it may have been you, Eddie, but someone else had made a post about getting to $1 billion. All they have to do is get to $1 billion. And he was saying the same thing to me. He was like, Rick, all I need to do is get to $1 billion. We were there. We got to get to $1 billion. I'm like, well, you're not. You did 35 million last month.
You're not tripling overnight.
Yeah, you're not going to get to $1 billion. And guess what? Do you know how many people? This would be a good question for the audience and you guys. I just looked this up, and I was kind of partitioning out the performance of mortgage lenders across the United States. I asked myself the question, I won't put you guys on the spot. I asked myself the question, how many lenders in 2023 did between $1 billion and $2.5 billion last year, right?
Great question. I have no idea. Great question.
I'll take a guess. I will say there was IMBs or just lenders in general.
Well, non-depositories, brokers or mortgage banks.
Non-depositories, I will say 40.
Yeah, well, it's so funny you say that. So it was 84 that did between 1 and 2.5 billion. Between 1 and 2 billion was 42. Okay, so it was like 83, 84 between 1 and 2.5 billion, and 42 between 1 and 2 billion. And I asked this gentleman who owns this company, I said, you're a really smart guy. And I'm like, guess what? There are a lot of really smart guys out there. And and only 42 of those really smart guys got to between 1 and 2 billion. And it's not because they're dumb and they're incapable. It's that they either don't have the experience, they don't have the leadership, they don't have the capital, or they just simply don't understand the systems that require like an intentionality to get to 1 to 2 billion. Because if you did north of $1 billion last year, it was very intentional. Like you had the systems, the relationships, the capital to do over $1 billion last year because it was hard. It was that hard.
Yeah.
And I just said, you don't have any of these things. You don't have the experience, I mean, you have the experience of getting over $1 billion.
On top of that, and then how many of them didn't contribute to the, to MorePack or the advocacy the way they should, and now they're not making money, right? And so now they're not going to contribute. I just find you have a duty, and there's a lot of people out there that are talking that either, and you don't need to contribute to MorePack if you're actually showing up and contributing your time. But if you're not doing either, you're having trouble in business, and you're having trouble with the possibility of disruption of business, which is going to make it even harder. Eddie, what are your, I guess, digesting what you just heard there, right? Mm-hmm. And I hear it too, is, well, we'll just get market share now. And that's coming from companies that are losing money. Why do so many people want more market share, which means they're going to losing more money now? Like, why is now the time to expand something that's not working? Is it because of that got to get to $1 billion?
Well, there's a false hope is what I would say. Because, okay, say you double. Well, more than likely your expenses are going to double with it and you're still not profitable. So I think there is a little bit of a false hope there. I think Rick pointed it out well. I think that net branch P&L model can survive for the big players like himself and probably 10 or 15 others, 20 others. But and I think there's something like 60 IMBs that do it. For the other 30 or 40, I think it's a long, hard road, and they really need to consider their options. And that's what I say to that. They're just, market's not going to come save you. Nobody's coming to save you. Rates aren't getting any lower. And let's go with some data here. Let's say rates do get lower. 74% of consumers right now are at 4% or lower. Okay. Well, how many are from 4 to 6%? It's somewhere around another 12 or 14%. So 90% of the market, somewhere around there, is at 6% lower. So if rates get down to 6, 5.25, that's still not going to trigger any refis. Sure, there's some refis that can get triggered. Will there be enough economic improvement? Plus, as we know, consumers will sit there and wait. Oh, it got down to 5. I think it's going to go back to 3 like it used to. Therefore, nobody's coming to save you. Nobody, except for yourself. And I don't think a lot of people have taken that. Like, I just got to get to $1 billion. Okay, do you have a recruiting strategy? Do you have an expense management strategy? How are you getting to it? See, the problem is people think the macro is going to save them. The market's going to save them, not themselves. And the only thing that's saving yourself in this market, because I still think it's going to be another 2 or 3 years, and I know a lot of people got crazy when I said that, is going to be yourself.
Yeah, and because there's so much outside noise, right? Like you have everything we just spoke about. You have the real estate piece going on, like buyers agents changing, and I heard an interesting thing. It's like if you don't charge a fixed price for your fees and you charge commission, sooner or later the regulators are going to find you, and that's what happened here. And that's what happened to our industry.
I don't know if it crippled it as much as it made it more athletic, because ironically, wholesale can't do more than 275, and it's helped them thrive because now you have full transparency. You know exactly the math. There's no hiding. I think that's part of the problem too. I think on the lender side, because you don't have to disclose it and margins get moved around and nobody really wants to talk about it. I mean, margins is like Pandora's box. Nobody really wants to admit what it is, because then if it's higher than that, they're going to get accused of from others about gouging your customers and how you do that. So it's kind of like this lie that's lived out there, or hey, it's almost like growing up in the 80s, and sad to say this, what I'm about to say is, I thought, pro wrestling was not scripted. I really thought Hulk Hogan body slammed Andre the Giant and won straight up. And that's what's going on there, is that a lot of these things are scripted and nobody wants to admit it.
And how much of it does the scripting start in DC? Like, do you want to, is it good to, if you're an IMB?
They're the ones that wrote Dodd-Frank. So what I would tell you is they laid out the rules, and then from there, some people have completely violated the rules. I mean, go look at it. I know a truckload of people. We've seen the lawsuits out there of originators lowering comp to say it's a referral here and there to try to be aggressive. That's all because of the yellow comp rule, because you can't adjust your comp, which is foolish, because DC truly believed that that's not fair to the consumer. I get their point, but the unintended consequences was, come hell or high water, the only person that suffers is the organization, and they probably don't care, because a lot of people are like, well, make the organization suffer. That's not really how life works.
Yeah, I think that when you everything has to be, it just sounds like everything has to be fixed, right? And when in life is everything uniform and the same? And the fact that you have to follow that exact rule makes it very difficult to run these P&Ls and net branches when the margin goes away to kind of make up for those mistakes.
Yeah. And then let's call it for what it is, because I once had that model years ago. A lot of these branch managers, literally non-producing branch managers, feel like because they brought somebody in office, there's this attitude like, I give you loans. It can be a little hostile, as I've seen, and this is from so many of my friends in the industry that run these models that have told me, they're like, hey, did you ever deal with this hostility? I'm like, well, absolutely. I don't think I'm special. They want to make net 100 basis points, and that's just bananas, because mortgage bankers, a mortgage lender makes about 30 to 60 in good times net, and not 2020 to 2021. I'm talking about normal times. So you have people that are running it that want to make anywhere from 2 to 3 times more than who holds the whole machine. Like, they don't respect the machine. They just are like, oh, well, you know what I do for you? I give you loans. It's like, bro, you're not the one with all the capital and everything on the line and built the whole infrastructure. That's all self-induced. We did it to ourselves because of the recruiting game and trying to get people and doing that. And it was bad behaviors for many, many years. And some of those bad actors are out, but those bad behaviors still linger to a degree.
And what's the so we're speaking, our audience is trying to be, for me, it's always been like loan officers, processors. Like, I was a loan officer, and very rarely did I hear what was going on outside of my zip code, right? And then I created the mobile app and went down there. Like, we started off the show 2013 MBA annual, probably about 140 conferences later. I'm living proof somebody can do that. And the more you do it, the more you see just what goes into this industry and what leaders like yourself have to deal with, and the difference in how leadership is different from lender to lender. What would you say to loan officers out there as they're trying to pick, the right pathway to go forward? And maybe that logo is the right answer.
Ooh.
Like be yourself.
No, you should always be yourself. It's too much energy to be somebody you're not. The best person you can be is yourself, because then you don't have to act or hold back. I'm not saying don't learn how to refrain, don't know how to articulate things better to get more effective communication. However, don't just bottle it up. Definitely be yourself. I don't know. That's a great question.
Rather than work for yourself, right? Like when your town sees you as an originator, are they seeing, like, should you be with have this logo backdrop, or do you think there'll be more of a movement where everybody's kind of white labeling all of the tech so they are themselves, even if they're working for somebody else? And then if that is the case, what's a better way to find out, who your leader really is? Because I think Andy said it on your show that part of the problem is these recruiters right now he felt like part of the problem, and teaching bad habits and recruiting on like bad
Of course,
philosophies.
man. That's always, there's very few recruiters I know a handful that do it the right way, but think about what I just said. A handful. And I got fingers left over in my one hand. Hey, I mean, look, they got to hit results, to a degree. I'm not saying that it should be done this way, but it's kind of, this is how everybody else does it. And I learned that because when I was building EPM up, I was on the ground floor leading business development. So I got to see all the bad behaviors and the stories and the shenanigans and what people were doing. We'll just say
he really went out there. I didn't edit that. What do you think of the show so far, Mike?
He's got some good stuff talking right now. I'm just curious, when we talk about the originators that are in this space right now, we still have, we still have limited inventory, and we still have some attrition to go when it comes to loan officers. And the reality right now is that we're in this woke generation, and we're just, I don't know why it is, and we've been talking about this for decades. Originators just don't want to telemarket. They don't want to get on the phones. They don't want to make the phone calls, and as a result, they're not getting the meetings they need to do in order to go get the business. And I think right now, at least if you're an originator and you've just entered into the business, so probably, let's say, the last 5 years, maybe you were sucking it between 17, 18, 19, and maybe the beginning of 20, and all of a sudden you get this boom, and you're like, I don't know how to provide value because all I was doing was selling rate.
Oh, I'm going to this one place, man. Look at their rate sheet. I go, oh, enjoy your 90-day rate sheet. What are you talking about? They'll start squeezing you in about 90 days. No, they won't. And then I jokingly always called it the 120-day rate sheet. And sadly, they did that because there was a perception, especially in retail, that, I can't just keep jumping companies or my real estate agents will leave me. It's kind of like they hook you in and it's like, hey, we got you. And shelf life is 2 to 3 years, so I'm just going to enjoy these 2 to 3 years, and then you'll go off on your own, and I'll just constantly have to be recruiting, almost like a Ponzi scheme. I got to find new people to cover the capital from the old people. So, yeah.
The flip side of that, you have the 90-day rate sheet, which I'm completely going to plagiarize you on that, by the way.
Oh, and it's not my original anyway. It's from my head of cap markets, my president, Phil Mancuso, El Presidente. He called it that.
But so you have the 90-day rate sheet combined with potentially, let's say, a $30,000 or $50,000 transition bonus with clawbacks. So that way, after 90 days, you're stuck there for 2 years or a year and a half because of the transition bonus. And there's nothing in the transition bonus agreement that's going to tie anything to rate or corporate margin or any kind of fee allocations. So you're pretty much stuck unless you want to cut a check for $60,000 or whatever the case may be. So it's such a well point and well stated. But I'll drop off with that. But it was, Eddy, awesome to meet you, man, and really good points. Michael, good to facilitate, man.
Yeah, I got lucky really to have him on and really have that dinner with him, because Eddy and I, when we first started, we were big on this Lenders One scene, and we talked about how a lot of the names really aren't there because of M&A, and before these large couple M&As, smaller M&As, but these were really the leaders. And when I was doing sales, it's tough that these were presidents and CEOs of IMBs that now I can't call on because they're regional managers. They're not as much decision makers, and they don't get sent to TMC or Lenders One, or maybe they don't go to the MBA because they're not at that extra level. And so you're losing leadership that was once, it's like they gave all this time and now it's just gone. And it's tough because they were friends of, Eddy and ours. So, and
They're gone, dude. They're gone, especially after Rona. After Rona, I mean, it's like I travel and I'm like, who are all these new faces? I see a couple familiar ones, but there's not as many as you think.
If it's really hard to sell not being yourself, Eddy, then I mean, when you have a 90-day rate sheet, you're basically saying, hey, you know what, I'm going to give you a good rate sheet so you can go capture some of that business just for your move. But if you're an originator and you want that rate sheet, I mean, as a recruiter, you got to be sitting there going to yourself, wait a second, he's just selling right now. That's going to be a problem because in 90 days, if he doesn't perform, I'm going to look bad as a recruiter or as a headhunter or whatever. So the problem right now is there's just not enough value. At least if you're an originator that came in the last 5 years, you just didn't provide that value. So if you're selling rate, that's a problem within itself, right? So
yes.
What are you doing then to say, okay, here's your 90-day rate sheet, but here's what we need to do as an action plan to make sure that you're already doing 4 to 8 loans a month. This is what we're going to do to actually get you get on the bandwagon, get on the plan, and these are the services or platforms that we're going to provide in order to bring when we do bring you on board, how we're going to help you. So how do you think we as an industry leader, what do you tell your colleagues to do that? Those aren't really secrets. It doesn't take much to get on the phones, but what else do you think we should be doing?
It's a great question because I exited retail because I did not believe that there was a great avenue for that because the support side costs money. And to your point, a lot of them are glorified rate salesmen, but they want all the support in the world. That's what would get you more loans, to your point, is more support, but that means you've got to take a lower comp. And the challenge you have is philosophically, and Rick was talking about it beforehand, he still had people who want all that support, and this one that was hemorrhaging still had everybody 150, 175 basis points. LO comp hasn't worked out as part of Dodd-Frank law. I know for a fact when I first got in the business, we did splits, but I was self-generated, getting 50% splits. We'd be lucky if we could get 2 on deals and all that back then on a paper or anything like that. Now it's by loan amount. You have people who do a $600,000 loan. Those loans back then, you'd make maybe 1.5 on them at best, all in. Now you have people who do a $600,000 a paper loan, and they're like, I need my 150. Seriously, you deserve $9,000 for an a paper loan with 20% down. I mean, come on, man. But that would be considered controversial, and I would be told that you don't know how hard it is to originate, even though I did originate for many, many years on my own, so I do understand. However, I've always said that Dodd-Frank was the greatest pay raise for originators and allowed them to become lazy.
Could see that. And I think when I was looking into the cash out refinance world recently for a client and making calls, I realized how few have loan officers that make calls like around and have tough conversations with their clients. They want to be these financial planners, but they call once a year and they say, well, I'm a purchase only loan officer because that became the thing to say. And purchase is more of the schmoozer, like you sponsor, and I mean that in a good way, but you sponsor the local little league, you go to the charity gala tonight, and then you go out for coffee and do a lunch and learn at a Starbucks for 2 hours, and you dominate social media on Instagram, and you give them a financial planning app, right? A loan officer who's a real financial planner, back when you would have to call your local orthodontist or your uncle's friend and say, I see, your credit card debt is getting a little out of hand. Let's draw a T. Look how much you're spending in minimum payments, and ask the tough questions. Does your wife know who handles it? What are you going to do when this runs out of a limit? Those are the questions, that require cold calling. And I think, COVID, among other things, has made it harder to find those type of loan officers. And maybe the LO comp plan had something to do with it and we didn't realize it. Maybe not.
I don't know. I think that one of the things you have to consider is if you're an originator, you're basically you're self-employed without being self-employed when you're working for someone nowadays, unless you're an actual mortgage broker, meaning you're brokering to wholesale lenders. And I think that when you have caps to, let's say you have at 125 basis points or 7,500 per loan, I think there's a certain point in time when you originate at a certain point. Why can't, if you're in retail, why shouldn't you be having some kind of income cap on your team? Right. For example, like, because as soon as you, let's say whether you're in California or whether you're in the Midwest, you're going to have those fixed expenses. And as you do more loans, you actually have diminishing returns. You pick up more assistants, you spend more on marketing. All of a sudden, you thought you were getting 125 basis points, but after expenses and assistants and so on and so forth, you're at like 65 basis points. And I think that unless you're an actual business person that actually understands and gets it, most people don't. That you're sitting there going, "Oh, you're capping my income. What's the problem?" Go ahead.
No, I laugh because you're very dead on. You're very dead on. They always go to the negative. They think it's, that you're driving around, it's like they believe that you're drinking champagne for water. And I'll never forget this recruiter. We were talking about a recruiter earlier who literally told me, I can't even make this up, I need you to pay me 50 basis points a loan. 50. Because I know that you're making a net of 200 basis points. I don't know how I'm still laughing, and it's been years to that comment about how delusional people are. And I would say that too about the originator. A lot of them don't know what's going on out there, even though the info's out there. MBA puts out plenty of information every day. NMP puts out information. There's plenty of industry stuff out there to tell you what's going on. They just don't read. They don't study the market 6 to 10 hours a week, their market. And what I mean by that is the mortgage market, the real estate market, what's going on throughout the whole industry. They just don't spend the time doing that.
Yeah, when I go into Starbucks, I usually tell them that I saw how much Schultz is making on their earnings report, and I want my coffee for $3. That's just... I have a question here from the audience, Eddie. It's a little bit to do with real estate. It could be hard hitting, but I'll give it to you, and you can see how you do with it. So the big question on the table in this upcoming week for the National Consumer Protection Week is how our industry, real estate and mortgage, can respond to make sure that the DOJ's efforts to uncouple real estate fees don't leave first-time home buyers at risk. Will existing mortgage regs allow buyers to finance buyer agent fees? Will the need to do that unleash new mortgage products to protect and empower home buyers?
Wow, great question. I don't think you'll be able to finance it. I don't know in what world Fannie, Freddie, and Ginnie are going to allow that. Now, if you get seller concessions on a purchase, it may get allowed. I don't know. I don't know enough about the regs and what's coming down when it comes to that, because I've kind of taken a back seat on the real estate side. I've spoken a lot with Gary about it. Gary Acosta, the CEO of NAREP, the National Association of Hispanic Real Estate Professionals, about it. And there's a huge wait and see game. So I'm not sure. I do believe this, though. I do believe that at some point in time there will be less agents. And I do believe at some point in time a lot of the listing agents become also buyer's agents. They kind of become de facto 1 and 2. And I know that the argument is, well, you won't have anybody defending you on the price and looking out for you. Well, yeah, you do. Because if somebody gets a bad reputation, then they lose their business. And there's not a whole lot of inventory out there. I don't think everybody has realized that yet. You're kind of going to get the deal that the seller's willing to accept, like it or not, as long as the appraisal comes in. That's just a fact. And you can get mad about that, or you can say it's different, but for the foreseeable future, at least another 5-7 years, we're in an inventory hole. It took us 10 years to get in this mess. It ain't coming back out in a year or two. Period.
Yeah, I was talking with someone whose daughter, I was on a Sandler sales training actually call, trying to bring that to some loan officers to tackle some of the issues we said here, and got paired up. And she said her daughter's looking in Colorado for a home, and so far unwilling to. By the way, the person said thanks, and then on your follow-up, I loved your first answer. Follow-up said those might be fighting words to real estate agents, but
that's fine. I know shoulders.
It is raw, Eddie. She said that their unwillingness to put in a waiving the home inspection has, the last 15 have gone where the seller's agent said, and this is really what you're saying, Eddie, you could have the best buyer's agent in the world. The sellers have all said, we're not accepting any In fact, if you had a buyer's agent, they'd probably tell you not to do it, right? So you wouldn't get a home this year.
There's not enough homes. I'm sorry to tell everybody that. The sellers have all the influence unless they're in a dire situation. And guess what? Even if they're in a dire situation, they'll get 8 to 10 offers on their house more than likely. So it'll still get solved.
What did Fannie and Freddie do different branding wise than FHA over the years to the point where sellers agents don't accept FHA offers and like it is what it is? Like how did we get to this point? And then that's okay with that's no one talks about that, but then they talk about comp. I just hear that a lot. Like they're just not accepting, they're going cash first, conventional next, whether maybe they know it through how much money you're putting down, right? But I don't know. Is that like a thing we can't talk about, or is that?
No. The real travesty is VA. So we have veterans who fought for our country, which, by the way, have the best performing loan in the market, and they get bumped because, an agent views cash and then, 10, 20% down as a lower risk and more likely to get the transaction done versus taking the best offer for their client. So I think the biggest discrimination happens against VA loans because they don't like it that the appraisal has to get done a certain way. And I know that the MBA is trying to work on ways to get rid of that, but that's a long way from getting done.
I have heard that pop up.
Mark Jones spoke about it when he went to the Hill a few weeks ago to some hearings. That's the real travesty there. It's just, it's credit profile, 20% down. That's all it is. And look, the agents can, call some shots, but at the same token, just depends on the area. If it's an area that's more rural, pretty much everything gets financed USDA, so they don't argue there. It's just, I'd say in your more burbs and big metro areas is possibly where that's happening, but that's not spread out throughout the whole country. How did they get there? Agents know what is higher chance of closing, and they go with the path of least resistance. That's most humans. If you told them it's that delayed gratification, it's the whole marshmallow thing that you've heard about. People do not want to delay gratification, and they will use the excuse that they're looking out for the best interest of their client. Sometimes they are, sometimes they're not. It's not necessarily true.
Well, we're coming here close to the end, and I think perception, is reality. And at the same time, in social media, I think, that word came up 15 years, a long time ago. Maybe perception is not always reality. We're learning, right? And because people are purposely putting out different perceptions of themselves. I'm going to run through the quick talking points of the NAC just to get your quick 1 or 2 words on them.
Yeah, sure.
Just so everybody knows, these are going to be the talking points. They just came out a couple days ago for those going down to advocacy. And if you're listening on the podcast, please put in the comments anything you want us to talk about. So trigger leads is obviously very important, and that one has support on both MBA and the broker side, which you're on the advisory board, right? Like the first real pack on helping them figure out how to build it.
Yeah, everybody is for the trigger lead reduction because consumers are just getting bombarded.
Yeah, and so in an ideal world, when you apply for a mortgage now as a consumer, you'll only get a call from the loan officer that last originated your loan or the servicer. I think is
with the trigger, the servicer still will, for portfolio protection, they will be able to receive if somebody's shopping out there.
Now, VA loan servicing standards, is that what Mark Jones talked about, like with WASP and those other pieces, or is this more standardization? Different.
He gave me. What's funny is I interviewed him for my podcast last week, and he gave me all the details. I'd have to look. I know the big one was.
We'll just put in the comments when that podcast comes out how they can find that.
Yeah.
Go direct to the source. Sure. Basel III Endgame, raising concerns about the adverse impact on the mortgage market. No specific bill. This would just ask legislators to contact. So that's something that is coming out. Is that more of an issue for 2025 in mortgage? We just got to get ahead of it. Is that when that drops?
Well, that's really affecting the banks because now they're having to write down their MSRs if it's a certain value and everything like that. So that's why you've seen more and more banks exit because Basel III has made the cost of capital much more expensive. So their concern is, and it makes sense, Basel III was written on European standards. Europeans' banking system is nowhere near as robust as ours. So to use European banking standards, 13 years ago when Dodd-Frank was written, this is kind of the unintended consequences of legislature. Like, it doesn't affect it, but now it's affecting things. So, their concern is if all these banks either have to write down and show losses, is that going to cause problems on their stocks and their boards? Of course. As well as if they start selling them, then they overheat the market and then it hurts servicing values for everybody else. It makes that asset have too much of a surplus, so then prices get hit. Those are all challenges in themselves.
The minority home ownership, several bills listed, for co-sponsorship. I think you mentioned NAREP that you work with. It's just amazing. And Rick mentioned earlier finding alternative ways to get revenue. Jason has done such an amazing job over there where it's not just real estate. They help so many small businesses as well, right? I just think our industry in general needs more, or luckily has at least some voices there, and we'll start to do some catching up in the minority home ownership. And good to hear this several bills, and always something you've probably fought for, and glad to see you guys got a lot of momentum there now at this advocacy conference, because this is the first one, I've really seen it as the talking point. Granted, the last ones have been Ron and appraisals, which obviously kind of touch on that too. The appraisal one.
Yeah, sure.
What he said. All right, so that was just kind of flying through those. That was our current event, since we skipped all that with an amazing interview with you, Eddy. I appreciate you coming on, and I could just tell from the audience, very few dropped off, if any. That's pretty rare for us. Mike and Mike like to. I'm just kidding. Any final words on you or your anything you want to push? Maybe your podcast. I know from your podcast you just like to push others. But thank you for everything you've done for this industry so far, and looking forward to seeing what you have innovative in the future.
Sure. No, I feel like it's my obligation and an oath of responsibility, because it's really, when I talk about pay it forward, it's really about those that paved the way, that made this road so good so that the next generation gets it. So it's really to honor those that built it through their legacy, to keep them alive. And look, Dave Stevens was a huge influence in my life, huge. And I feel like as an industry, a lot of us, it's going to take a lot of us to lift a giant and to really step up. So in other words, we need a bigger army. We need more people out there to advocate, to talk about all the things. And advocate doesn't just mean politically. It could be about, if we think the fees are kind of crazy, that the credit bureaus have created and just expanded upon. Like, it's out there talking about the things that in the end will affect the consumer. Nobody ever thinks about the consumer, when all they should do is think about the consumer. And that's one thing that Andy Harris touched on that I agree with him on. So I think if you have a consumer-centric mindset, and obviously the greatest way to empower the consumer is to empower your associates and all your partners. So if you empower them and you make them understand that it requires unreasonable hospitality, then the consumer will be very well taken care of. And the consumer will be our biggest advocate, because they'll tell all their friends about how great of an industry. Because that's always my only real fear is, I remember what it was like to survive the financial crash in 08 and 09, and the way people looked at you and blamed you for everything. And I don't ever want us to be viewed that way again, because we do such a great service and duty for our consumers in our industry. There's not a whole lot of industries, if there is one at all, that lifts as many people up, helps them create wealth, gives them a place of shelter, even if that's on the commercial side for apartments, and keeps them from being homeless, and has an impact on everybody's lives every day, like this industry. And that should always require the highest oath of responsibility with honor and duty.
Yeah, extremely well said. And that was what we wanted this show to show raw, that the loan officers out there that are working with these customers, mortgages don't just happen with a snap of the finger. At these conferences, there are leaders like Eddy and many others that are attending constantly different sessions, walking the hallways and advocating. It just, in order for it to work, the next rising star has to come up and be part of it, and the next after that, and the next after that. And ultimately, that'll protect the system we have and help customers, so it stays in the hands of people that care, that have the passion. So thank you, Eddy. Appreciate it.
My pleasure.
And good luck with your son and everything with
Okay, thank you.
with the sports. Thank you.
Thank you. Thank you.
Thank you, everybody. Appreciate it.